Testing. Am I good? Hey, good afternoon, everyone. It's a little bit of work getting over, but I really appreciate the opportunity to be here this afternoon. And I'm Mark Sachs from Right Line Trading, and I just want to start with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures or forex markets or stock markets for profits or losses. It should be understood that a person can lose a substantial amount of money. Therefore, participation in these markets is not appropriate for everyone. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account on any trade. And Right Line Trading we are not registered financial advisors and not licensed commodity advisors. Now, they're doing some work on the outside of the office, so you may hear a little bit of banging. I tried to tell them to go away, but they can't because they're contracted by the office building. So if you'll indulge me, I'd appreciate it. Hopefully they won't bother us too much. Now, what I want to start talking about is the oscillator. Now, if you go on YouTube, you're going to see a lot of information. Actually, what you're going to see is really a paucity of information about this indicator. And I don't think that many traders understand how to use it and leverage it to create really good trading opportunities. So I want to spend a little bit of time going over it because it's one of the indicators that we use on the market scalper system that provides us with a lot of specificity and helps us make sure that we get into winning trades. Now, the oscillator was created by a mathematician by the name of George Lane, and he created it in 1957. Now, an oscillator is a momentum-based tool. What it does is it looks at the momentum associated with price movement. And momentum is really a very key metric in your being able to assess a trade. Now, to give you an example, if a car is going around a racetrack at 100 miles an hour and the speed is constant, momentum is a flat line because momentum is a second order derivation. And this is the reason that George Lane considered it to be so critical. Because what it does is, it doesn't measure speed, it measures the rate in change of speed. So if that race car begins to accelerate faster and faster and faster, momentum begins to increase to the upside. If that race car begins to slow down, then momentum begins to decrease to the downside. And such is the same with price. As price accelerates to the upside or the downside, momentum increases. As price begins to move up with less increase in speed, momentum is diminished. Now, because it's a second order derivation, it measures delta speed. George Lane considered it to be a leading indicator. And back in 1957, now just as an aside, George Lane, according to Google, died a pauper. But I believe in 1957, when George Lane developed this indicator, it was extremely accurate. And the only thing that he used the stochastic oscillator that he built was to foreshadow reversals. And that's when the indicator revealed bullish or bearish divergence. Now, we'll talk about the problem in trading divergences today versus trading them in 1957. But this is one of the first indicators ever created. I think the only one that was created before this was the MACD. Now, just really quickly, I want to show you the formula so you'll understand what the percent K line is, or the momentum line. C in the formula is the most recent closing price, and it looks at the most recent closing price and compares it with the 14-period moving average of the last lows of the session or the candles, or the 14-period moving average of the last 14 highs, depending upon whether you're looking at days or hours or minutes. It's the last 14 periods. And as the close of the candle approaches the high, or that 14-period high, momentum is moving to the upside. And as the close of the candle approaches the low, momentum is then accelerating to the downside. So let's take a look at an example of the way momentum most likely, or the oscillator most likely, worked consistently back in 1957. And right here you see the price starts here and it accelerates up to here, creating this much momentum. And then it retraces, and when it makes an equal high, it accelerates up to this price. It has less acceleration. So it only creates this much momentum. Now it tries to make a third high, and its acceleration up to this high is about the same as the previous. And because momentum is waning, the price is moving up with a smaller degree of price acceleration to this high, as opposed to this high and then this high. It foreshadows a complete collapse in price. And I believe that this was very accurate back in 57. Here's another example of trading divergence. Price accelerates up to this high and retraces, then accelerates up to this high. But it does so on creating the same amount of momentum. When price makes a higher high, it should make it on a greater amount of momentum. It should accelerate to a higher high faster than it accelerates to a lower high. And what you get is you get divergence, and it foreshadows a collapse in price. Now, back in the day, the overbought, oversold signal was also very, very worthwhile. Here, you're selling an overbought market. Here, you're buying an oversold market. You're buying an oversold market. You're buying an oversold market. Here, you're selling an overbought market. And here you can see this, the percent K line crosses the 80 line here, and you get a really, really nice move down on Facebook. And it crosses above the 20 line here, out of the oversold region, and you get a nice buy. Now, this is just not operational anymore, and I'm going to explain to you why. In fact, your whole trading paradigm, the way that you trade, has to change. And I'm going to explain to you why. I'm going to give you some of the trading rules that are operational in the market scalper. And what's happened now is that overbought doesn't always mean overbought. And you and I both know that a market, a stock, a future, a Forex market can stay overbought for not only a day, can stay overbought for a week or a month or many months, depending upon the time frame that you're looking at the instrument. So if you look to fade a divergent signal, now you're most likely going to get run over. And here's the reason why. The market now is dominated by institutional money. Institutional money comprises probably 60 to 75% of almost all the futures markets and all the Forex markets. And on a big stock move, it also comprises a large percentage of the total volume crossed in a given day, if you look at the number of shares traded. Now, with institutional money dominating the direction of every single financial instrument, we simply cannot look at overbought and try to fade the market. And it's important to remember this, that all financial instruments are interlinked. No market moves in isolation. And what happens on a day to week to monthly basis is that institutional money, banks, use algorithmic trading to rotate their money from asset class to asset class. When risk is on, they're going to buy stocks, and they're going to continue to buy stocks. And they may buy stocks for days, weeks, or months. And if you try to trade a divergent signal, you're going to get run over. The same is true for futures, and the same is true for Forex. The oscillator moving into overbought territory no longer means you can fade the market, with the institutional money determining the direction of almost everything we trade. So we have to change the way we trade if we're going to trade profitably. And these are just some of my trading rules that I've developed. Now, I believe back in 1957, when the market was dominated by small commercial traders like us, I believe that divergent signals and overbought, oversold signals were probably very good. But at this point in time, they're not going to get you where you want to be, which is making money almost every single day. So in the era of institutional volume, here's how I believe you have to trade. I don't believe there's anything as overbought or oversold. I believe this is a fallacy now. And I don't believe there's any mathematical derivation that can calculate when there's going to be a turn in the market, because it's not governed by small commercial traders, it's governed by big money. And big money is going to continue to push any financial instrument higher until it decides to step aside. We can't use a mathematical equation or any indicator that we ever created to determine when those institutional players are going to step aside. So it leaves us with only one thing that we can do, and that is understand that markets reverse only at the whim of institutional money, bank money, big money. Now, the mathematical principle that is still operational and important is that price always has a desire to revert to the mean. If for you it's a 50-period moving average or a 100-period moving average, it doesn't matter. Once institutional money steps aside, price is going to retrace back to mean price. And that's always going to happen. And what counter-trend traders are always looking to do is to catch that snap back to the mean. The problem is we can never determine mathematically when that snap is going to occur. And you're going to see when I show you a live chart that they're going to get run over and over and over again until finally they catch that snapback. Now, the further that institutional money pushes price in terms of standard deviations above the mean price, the more powerful will be the snapback. So right now, to trade a divergent signal is tantamount to trading against institutional money. You can only trade in the direction of institutional money. So what we do is we use indicators that act as proxies of telling us the direction of money flow. That is the key. There's no way of actually directly determining when money flow itself, but there are great proxies for looking at the direction of big money. Now, I just want to take this one step further. It's not on the slide, but there's certain things. There are other changes that have taken place in the market that I really want to warn you about, because there's a lot of software vendors out there. They're not traders, like the people who are presenting here today. They're just looking to sell you stuff, and they don't care whether it works or it doesn't. And that is that a lot of the things that are out there right now, like Elliott wave, like Gann theory, like Fibonacci, which is to me not controversial. I don't believe it works. Also Japanese candlestick patterns, which I love, but I'm going to tell you why. All of these things have been substantially weakened and are no longer great tools to use to trade. They were created based on the premise that the power of every buyer is equal or approximately equal to the power of every seller. When the Japanese rice traders created Japanese candlestick patterns 400 years ago, that was the way it was. All these thousands of small traders trading. And that's the way the market was for many decades after it was developed in the 18th century, 19th century. I don't exactly know when the NYSE came about, but each buyer was equal to the power approximately of each seller. Japanese candlestick patterns work great in calling market sentiment. And Gann theory and Elliott wave, which believe that there's an intrinsic waveform present in each market that moves price in this closed system, is all skewed now, because institutional money steps in and destroys it. And Fibonacci also, based on a retracement, and I'm not particularly fond of it, is also destroyed. So all we can do is track the direction of big money. And these prefabricated formulas that predict out into the future where price is going to go based on where price has been does not take into account the fact that institutional money and bank money could step in at any time and just blow price to the upside. What you want to do is be in the move, 1/2 step behind big money. And that's the only way, in my opinion, you can trade profitably. Now, every single oscillator out there is geared to try to catch divergence, except for the Laguerre oscillator. It has a default gamma of 0.5. It has multiple smoothing components, all of which we've modified. The Laguerre does not look for divergence. It looks to track the direction of momentum. And that's what we use as one proxy of institutional money. And it's very powerful. Now, I'm going to show you now one other thing that I'm really giving you a lot of information about our trade methodology, which I believe really to be very sound. And listen, I'm not dogmatic about my believing this is the only way to trade. I think there are many right ways to trade, but there are a trillion wrong ways to trade. And what I am is a proponent of the triple screen method. I believe that every indicator and everything that you use on your trading chart must use data from your 2 higher time frames only and not use data from your trading chart. No indicator that assimilates price movement from your trading chart is going to be able to tell you where price is going to move on the right edge of the chart. It ain't going to happen. So with the Laguerre, we look at 3 time frames. We have to look at the trading chart because we want momentum on the trading chart to be in the direction of the long-term Laguerre, which looks at the 2 higher time frames. If you're trading a 3-minute, it looks at the 9-minute and the 27-minute and creates a multi-time frame momentum assessment. And this is telling you that price is accelerating to the upside throughout this period of time. And the Laguerre here is locked long, which means on the 2 higher time frames, it's plastered to the 100 line. And the only thing that could do that is institutional money. Now here, where the Laguerre is mostly yellow, so the 2 higher time frames show no alignment, and the Laguerre on our trading chart never comes in sync with the long term, the market simply moves in chop. And there's no defined direction. And if you try to trade it, you're going to get stopped out. But when the long-term Laguerre or the 2 higher time frames show that momentum is locked long, institutional money is now at play. This arrow tells you that the Laguerre on our trading chart has crossed the 20 line and is now heading up. So we've got 3 time frames with price accelerating to the upside. And here's our entry. And we're going to take this trade long until we get the down arrow, which is the cross of the Laguerre across the 80 line to the downside on our trading chart. We're out. Now, if we try to look at oscillator divergence, we would have been stopped out. What we're doing is we're trading in the direction of big money, and the multi-time frame Laguerre is giving us a proxy, is being used as a proxy for when there's such incredible buying pressure that it locks the Laguerre long and price continues to accelerate to the upside for a long period of time. And the same thing here. When the long-term Laguerre is yellow with a dash of red and your chart Laguerre is green, you just don't have anything to trade. And if you try to trade it, you're going to wind up getting stopped out. This is just chop. Here's where the action begins. The long-term Laguerre locks green. The chart Laguerre crosses the 20 line to the upside right here. And price is going to be forced up because we know what's happening on the 2 higher time frames. That's the key. And you get a great 3-minute long trade. This is the financial instrument here is irrelevant. The time frame is irrelevant. Both Laguerres are locked short. The long-term Laguerre and the chart Laguerre. Look at the chart Laguerre. It's plastered to the 0 line. And it comes up a little bit, but this is tremendous selling pressure. Only institutional money can create this kind of setup. And there's the cross, the short. You get a retracement, a counter trend move. You go short and run these long traders over. There's the arrow. See the Laguerre crossing the 80 line in the direction of the long term. Get a big move to the downside. And in my opinion, it's the only way you can trade. When big money locks the Laguerre long or short, only institutional money can do it. Here's a long trade. You can't take a long, and part of my rules are, in order to take a long trade, the 50 has to be green and the 15 has to be green. This is an 50 exponential. This is a special line we created. It's a 15 exponential of a 15 exponential, and I'll go over that when we go to the chart. But you get the pullback. This shows you that the bears are trying to turn the market. You're in one tick above the close in the direction of big money. And although we don't trade like this, we only take a long above the 50 when the 50 and the 15 are green. It shows how powerful it is on a 30-minute to trade a locked Laguerre, a multi-time frame Laguerre. This is a 30-minute. So this is looking at a 90-minute and a 270-minute on the long-term Laguerre assessment. Here's your short on a 3-minute. Here's your short on a 60-minute. Now, the only other thing I want to show on the slides, and then I'm going to move over to the chart, is the difference between the Laguerre and stochastic and relative strength. The Laguerre, as I had mentioned, is not looking for divergence. It crosses the 80 line here. So you've got your chart momentum, price accelerating to the downside into the direction of the long term right here. But if you're trading stochastic, it's looking for divergence and it pops above. See it crossing the signal line and you're out of the trade right here. And relative strength gives you no entry whatsoever. So these oscillators looking for divergence are not going to keep you in the direction of big money. That's what the Laguerre is geared to do. Now I'm going to take the slides off. And what we're going to do is we're going to go to the trading chart. Because this is really where the pedal hits the metal, so to speak. And there's a few additional things that I want you to see. Now, we've included these additional things in this webinar as a special, and they're going to help you trade immensely. First of all, I want you to look at the pivot indicator. This is a very unique pivot indicator. Now, this is a Unorenko chart, and I'm going to give you these examples on Unorenko. I started trading 15 years ago using a tick chart. I then went to range, and now I've become a Unorenko devotee. The system doesn't matter what you trade. You can trade time, you can trade tick, you can trade any financial instrument. These forces that move price are completely time independent, instrument independent, and the kind of candle you use independent. And later on, I'm going to go into the window and see if anyone would like to see a separate instrument or a separate time frame, and I'll convert it for you for that. Now, what I want to show you, this is the NASDAQ, and I want to show you the pivots. Now, most indicators are lazy, and they create a pivot off of a wick high, and that is not correct. Japanese candlestick dogma is really clear that pivots are created off candle body highs. And if you use them off of the wick, you're going to get stopped out because you're going to think that the pivot is much higher or much lower than it really is. And what really is a pivot? The pivot is where sellers came in and turned the market. So you can assume that at this line, there are lots of sellers. Now, there's all these sophisticated tools, volume ladder, all this stuff to tell you where there are hidden buyers and hidden sellers. But you know what? This is a live market showing you a live turn where price actually reversed in direction. There's nothing more accurate than an appropriate pivot indicator. Price comes up to the pivot, it gets turned. Price comes up to the pivot, it gets turned. Price comes up to the pivot, and it gets turned. So one of the rules that we do is we never trade into an unbroken pivot. And trust me, it's going to save you your whole trading account. Number two, also Japanese candlestick dogma, and something that very few pivot indicators do, is a pivot is only broken when 2/3 of a candle body closes above it or below it. And that's a very, very critical moment, because that true break of the pivot is when you start to stop out all of the sellers and they propel the trade in the long direction. So you're going to see when we take an entry on a break of a pivot, it rockets down because we're capitalizing on all of these traders that are now caught in a counter trend direction. But until that pivot breaks, and you can see it's still tracing, even though price came all the way up to here, it's still tracing. And that's a very, very powerful tool to keep you out of losers. Another indicator that we're including, and this is the first time we've ever done this, is our consolidation indicator. Now, consolidation is hard sometimes to see. It's hardest on Unorenko, and easier to see on range. I think on time it may be a little bit difficult, but consolidation is extremely powerful. Now, what does consolidation do? It traps buyers, sellers, buyers, and sellers in a narrow channel that the software defines. And everyone in this channel is sweating it out, because the break of the channel is going to stop out a ton of buyers if it breaks to the downside, and stop out a ton of sellers if it breaks to the long side. So today, it saved us a big loser. We never trade in the channel. We trade the 2/3 candle break of the channel. And you see, here's the break of the pivot. And look what happens. It just fires right down. That's our entry. Right there. Until we break the pivot, and the pivot is going to stop out all these buyers, and down we go. Now, we can't trade out of consolidation here, but consolidation is almost always likely to break out into the direction of the trend that it was when it went in. The trend was down, it retraced, but it's most likely to break back to the downside. But we trade what we see, but that's our anticipation. Now, hang on a minute. Here we go. Whoops. So consolidation is very important. And if I can show you a trade today, this is today. We had great trades on the NQ. And if I can find a trade, it was this trade right here. This was a perfect short. And because we were in the channel, we had no trade. Saved us a loser. So the consolidation indicator is also extremely important. Now, this is a 50 period EMA, and this is a 15 EMA of a 15 EMA. It moves as fast as an EMA, but it's more stable than an EMA. And if I quickly overlay a standard EMA, you'll see what I mean. This has all been mathematically optimized to give you really the best opportunity for continually scalping great trades. And you see here, when price comes back, the standard EMA gets shoved all the way down and then up. Shoved all the way down and then up. Our line remains relatively stable. And that's what we're looking for. So it's far better than a standard EMA, even though it is a 15-period exponential. We just took the exponential twice to create a new line to give us added stability. So the only other trading tool we use is the most powerful that there is. And I'm telling you, there is nothing more powerful than this. There's a formula called the non-linearity of independent variables. And this is the most powerful independent variable or force we have on the chart that predicts the direction of price. It's background bias. And you can see right here, it's green. Now in background bias, it's green. It means we have a multi-time frame alignment in price and market structure to the upside on our higher time frames. And when price is above the 50, above the 15, and they're both green, taking a long trade in the direction of the multi-time frame Laguerre, here on the pullback and the move up, there's your counter trend trader, oscillator divergence, MACD divergence, Fibonacci, blah, 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 calling a market top, going nowhere. We run them over and we take it long again for an enormous move on the NQ. Always in the direction of the multi-time frame Laguerre. So this background color, which doesn't use price on our trading chart to create, is such a powerful predictor of the direction that price is going to move on the right edge, that the only trades we really take in the room are with green to the upside or pink to the downside. Right here too. This is what happens when you get a multi-time frame alignment. And this is only going to happen when institutional money comes into play. This is the move up, and that is the trade. And here it is again. Believe me, this is no accident. And there's the counter trend traders. There's your two counter trend traders. There's three counter trend traders. They're going to get wiped out. You can't go short when your two higher time frames are angled long. If you do, you're going to get stopped out. Now, pink is your really low risk color to go short. So if you trade dark green and you trade dark pink, you are trading with institutional money in a multi-time frame direction. And when the Laguerres align, you're going to get a very, very low risk, usually very high reward trade. Now we call this the market scalper because if you shoot for 2.5 points on the NASDAQ, you can get that 90% of the time. Now there's one more indicator that I want to go over with you. Hold on one sec. Okay. Here we go. It is this blue line. This blue line is a measure of volatility. And we want volatility to fall as we take a trade. I mean, it's actually a measure of chop. As this line goes up, the propensity for chop to develop becomes higher. So when we take a trade, we want to take it into a falling blue. It's called fractal energy, and it is optimized for the system on the Ligier. And I'll show you how it works really great. It will censor losers. And I'll show you a losing trade I took today because I didn't respect it. And it cost me a lot of money. And I'll show you where I took the trade. Hang on a second. I'll find it. I took it right here. I took this continuation long trade. I had everything I needed. Green background, Ligier's locked long, but look at the blue line. The propensity for chop or volatility was rising on the trade. I didn't respect it. I actually didn't notice it, and it blew me right out of the trade. It was a trade that was censored by that line. And what we want to do is trade the lowest risk trades possible. So if you put all this together, you're going to get unbelievable trades if you stay with green background and stay with, I'm just going to move to a different time frame, and you stay with pink. Now you can see there are other colors. Now I want you to know that this Thursday is masterclass number 2, which is part of this package. We've already done one, masterclass 1. You'll get that on a link. It was an hour and 45 minutes. It's very detailed and is a lot of trading information. So you're going to learn all the nuances of the system. And in fact, you're going to learn, I believe, how to trade appropriately. Well, like I said, there's a lot of right ways to do things, but you're going to learn how to trade one way that I know is going to make you money. Now, I just want to throw in, we gave you a system-generated entry. It's this line. It's a multi-time frame assessment of range. And you don't see it often, but when you do, the likelihood of getting a winning trade is very high. And I have to find it because it doesn't trigger often. And now this is no trade. I mean, it's got a trigger. Here we have no trade. Now here's your trade. Now the cyan background is a little weaker than the dark green, but this entry with dual Ligiers, and this is a multi-time frame alignment to the upside, gives you a long trade and a winner. And in the master class, I will describe the difference in power between the different background colors. And here's another trade. Now this has no background, so it'll be difficult to trade, but there's another winner. There's another, and that's another winner. It's a very good signal and requires a lot in order to get it. And if I open it up for you, I'll show you that it does a multi-time frame assessment of range and looks at price action and market structure on the 8 and 11 range to give you an entry on a 4-unit Renko. So it's a very complex assessment. Here it is again. That's a winner. You're looking for 2.5 points. No sweat here. Every candle is 4 ticks. So that's 4, 8, 12. That's way over 2.5 points. 10 ticks. And look at that entry. Now you can't take it, but this is the kind of signals you get off of it. So what I'm going to do is I'm going to open up the room to questions, and I'm going to look at any financial instrument you want, and I'll look at any time frame you like, and I can look at any future, and I can look at any stock. If you want to see a Forex, I'll have to save that to the end. So hang on, let me go to questions. And before I do that, let me just show you the offer, and then I'm going to go to questions. And actually, I'll show you the offer at the end. We have plenty of time, and let me find the questions here. Here's the chat. Hold on a second here. I'm looking to hold on. Okay, here it is, I think. Okay, this is not for me. Okay, let me keep going. Okay. 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 I'm looking. Okay, you want to see the 6E? No problem. Let's go to the 6E. I'm gonna have to move off the screen. All right. Now let me just make sure that I have the right month on the 6E. So hang on one second here. Because we don't normally trade the 6E. You know what? I have a 6E chart, but let me just make sure it's set up correctly. Hang on one sec. I have a feeling it's fine, but I just want to make sure. No, the 6E month is moved to 9. So let me rotate the instrument to 9, and take out my my prior 6E. Hang on one sec. Let me take out the other one. Okay, I'll show you the 6E now. It's loading the data. Got to give it a second. Okay, now the thing about the 6E is, we have to change the Unarenko speed. Now all of these settings are going to be given to you, so don't worry about this. We're going to give you all the automated trade management strategies. Obviously, the consolidation indicator has to be changed. You know what? I'm just going to take the consolidation out for a second just to make it easy. Because we're going to give you templates, which will make this very, very easy to switch. And this goes from 13 to 8. And with a template, you can just insert it. So here's the 6E. Now there's not much, and here's your move down, right here. There's your signal, dual gears. Here's your signal. On any of these pullbacks, and you're down. Right here. Pivot breaker. You have this Ligier. Multi-time frame Ligier is red. The chart Ligier is heading down in the direction of the trade. And I've got a black line on here, and let me get it off. I don't know what it is. Let me get this one off. There we go. And you can see that the fractal energy is rolling to the downside. It's just the direction we want on the trade. And look at that long trade. Right here. It's a monster. Just have to wait for this alignment. You're going to get these over and over and over again. Cyan's a little weaker than the green, but you've got your chart Ligier heading up in the direction of the multi-time frame, and the blue line is heading down. You're in on the pullback, and up you go. And we're going to really review this in depth in the masterclass. Now, if you got completely out of the trade, you could re-enter here and go long again. So you have multiple opportunities to trade. There's your pivot. Remember I told you the pivot is the kiss of death on a trade? Try to trade into it, loser, bounce. Try to trade into it, loser, bounce, and up you go. Your goal is to not take losers. And look at the system generated short. Kaboom. Okay? Now, the DAX, I can't show you because I don't have a DAX feed. I'm sorry about that. But trust me, the DAX trades exactly like everything else. Just like you see the 6E, that's how the DAX is going to trade. Sure, crude oil, not a problem. Remember, your goal as a day trader or swing trader is not to get winners. Your goal is to avoid losers. That's how you make money. I tell you, I have a teenage son. He could get winners, plenty of winners. What he could not avoid are losers. Now we have to change this to a 13, but you get that template, so you don't have to make any of these changes. And Sergio does the complete setup. So let's look at crude just as an example today. Let's start in the morning. It's 5 o'clock in the morning. You see, you're in the pivot. There's no trade, no background. There's your pivot breaker right there. 922. I'm telling you, there are a lot of traders in the room who took that trade. Now, our trading room wasn't open yet. Now, it's up to you whether you want to hold through this pivot or not. You already got a lot of money. If you want to try to shoot for more, you can, or you can close at resistance. Now, I'm not going to take a trade on blue background. There's your green, and there's your continuation for a winner. Now, there's your next trade, pivot breaker, right up to resistance. There's your pivot breaker. Now, you don't have the long-term Ligier here, so you can't take this trade. That's censored. Right here on this pivot breaker, I don't know, that's about 5 or 6 winners in a row. Right here. just going to keep going. That's it. So there were no losers because we're trading in the multi-time frame direction of crude with the Laguerre's lock long telling you there's tremendous buying pressure in the market, trading either a flat, and actually this was a little risky of a trade because you had our fractal energy rising. And it might have been a trade you wanted to step aside on. Remember, our goal is to avoid risk. And if it turns out to be a winner, who cares? We want the low risk entries. And this is a really low risk entry. Right here, right here, right here, right here. So you could get multiple. A lot of people made a lot of money in the trading room today on crude. Okay, I can show stocks, I believe. Let me just bring up, I have 3 more minutes. Let me show you the offer, and then I'm going to show you Nokia. Okay? And I'm just going to bring this over. And I believe I can dial in Nokia for you. Now here's the offer. You get the market scalper. Now you can see if you're going to go for 2.5 points on the NASDAQ, if you're going to go for 7 ticks on crude, if you're really going to be a scalper, your percentage is going to be astronomically high because you're always trading in the multi-time frame direction of trend. You're always trading in the direction of institutional money. You've got dual gears. You're not trading into support or resistance. You've got a very, very low risk, potentially high reward trade. How many contracts you want to trade as a scalp is up to you. We have a 2-tick, 10-tick, 2-contract, 10-tick scalp. What we've been doing is taking a 2-contract, 10-tick scalp and then taking a runner. And the runner's given us really nice money. The bonus indicator is the pivot indicator, which we don't normally include. You get the 5, these are live classes. And number 2 is Thursday. They are long, and I'm telling you, I killed myself on them. They're very in-depth. And we're going to teach you really the right way to trade. And you're going to have to cleanse your mind a little bit of all the stuff you've been taught, because you've been taught a lot of wrong stuff. And the reason you're going to know I'm teaching you the right stuff is you're going to make money. Then you get 100 training videos. Now, we are going to give you all the trade management strategies. What we recommend, first target, second target, stop, we'll program them for you. You're going to come into the trading room with me for a month, and we do the entire setup for you. I don't care if you're on a 3-minute, an 8-minute, whatever. We will do the complete setup for you. Now, it's normally $15.94. It's $7.97 on a permanent license. It includes the master classes, which are $7.97 alone. Now, the sign up is rightlinetrading.com/market scalper if you want to come aboard. We'll be sending you an email, but that's the offer. Now, let me quickly see if I can dial in Nokia. I may not have any time to do it. And I'm sorry. Let me see. No, on the 4-unit Renko, the higher time frames are the 6 and 8-unit Renko. Okay? I'm just not going to get to stocks because I'm going to run over, and I don't want to be rude. If you want to see stocks, just give me a call and I'll show them to you. Believe me, they trade exactly like futures. And if I didn't tell you what was up here and tell you this was crude, you would not know the difference. We're going to give you the Unorenko candle size based on the price of the stock, the whole trade management strategy. We're going to teach you that, Bondwire, B-Wire. Don't worry about that. We will. Hi, Heinz. I don't have a DAX feed. It's NinjaTrader 7 or 8. Either one it works on. And the offer's in the room, and our number 786-732-4656. That's 786-732. It's on our website. And if you have any other questions, let me know. Just give us a call. The master class is really, I think it's terrific. And you're going to get 8 hours of master class, one on digital replay. We're going to send you a link. So listen, everyone, have a wonderful. I'm sorry I can't get to stocks. I'm already 2 minutes over, and I don't want to be disrespectful to everybody here who's giving this who's organized this. So everybody have a wonderful afternoon. I hope to see you in the training room. We make money 4 out of 5 sessions, and this system really does work. Take care, everyone, and have a great, great afternoon. Bye-bye all. All right, I just hit the